Welcome to FinTech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. Each month this year, it feels like there's more and more massive changes that are happening around Web3. And July did not disappoint. The White House digital assets paper, they believe that this is the time when America officially became the crypto capital of the world.
For payments geeks like us, this is officially a milestone in the evolution of money.
The month of July, you see $5.3 billion flow into digital asset projects.
There is now a growing market for blockchain infrastructure providers to create these new assets in the marketplace.
Bitcoin hits a new high, $123,000 a coin. Ethereum, their corporate holdings surged 127+% to over 2.7 million ETH.
Stablecoins also underpin and are the backbone of the larger DeFi system. These stablecoin issuers are interested in launching a bank so that they can
Coinbase, 6,200% increase in average trading volume.
The Genius Act, the very first law on the books in the US governing cryptocurrencies and digital assets.
It is the first major stablecoin under the MiCA regulation.
The stablecoin market, three main pieces that are kind of the high growth areas. We're already seeing strong demand for US dollar regulated stablecoins because it's still viewed as a safer store of value, even safer than.
You're building a fintech product. You want to offer digital assets, but wallets, that's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Defense. They provide wallets as a service that's API first, multi-chain by design, and secured with MPC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Defense. MoonPay scales wallets securely with Defense. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Defense to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Defense wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Defense, secure wallets built right. Welcome to Web3 with FTC. If you're asking how blockchain, crypto, AI, or even quantum computing fits into your business strategy, this is built for you. We talk with the builders, decision makers who are doing the work. You'll hear smart conversations, straight insights, and no filler. Whether you're a founder, an executive, or just trying to stay ahead, I'm your host, Ted Huff, the CEO of Voliere, a fintech advisory firm, and I'm here with my confidential informant, Rob Musiala, a partner at Baker Hostetler, and he leads their Web3 practice along with the blog, The Blockchain Monitor. You need to go check it out at theblockchainmonitor.com. And Rob, I've got to tell you, each month this year, it feels like there's more and more massive changes that are happening around Web3. And July did not disappoint. And I'm going to give everybody a little bit of sneak peek, but I'm going to take a quote out of the White House digital assets paper and say, they believe that this is the time when America officially became the crypto capital of the world after the report as well as the Genius Act that came out. And by the way, this isn't just us having fun with this. It really is a historic moment. And I'm really excited for us to dive into that.
For payments geeks like us, this is officially a milestone in the evolution of money. And that's fascinating and it's exciting.
So what we're covering today just isn't going to be another monthly review. Rob and I are actually going to dive in and break down the Genius Act that the president signed into law on July 18th. We'll explore the comprehensive White House report that dropped It's 166 pages of policy recommendations, and we'll analyze the record venture levels that are going on. We're talking like $10.03 billion in Q2 of 2025 alone. But Rob, there's more happening internationally that's really forcing America's hand in this. The global dollar just launched in the EU, or USDG, is falling under the micro regulation, and it's expected to reach over 450 million consumers across more than 30 countries. And really, this is the first major stablecoin launched in the EU under the regulation. And some people look at it as directly challenging the US dollar dominance in payments. Now, that isn't the only place that we're seeing stuff. We're seeing market performance be way higher than what it's been, and it continues to grow. In July, Bitcoin, the one that everybody uses, the bellwether, right? It hit well above $123,000 a coin. And Ethereum, their corporate holdings surged 127+% to over 2.7 million ETH. And not only that, but we've got some really cool infrastructure plays that are going on. We've got Circle, who filed with the OCC for the first national currency bank charter on Charter. Ripple's pursuing both a national bank charter and a Federal Reserve master account access. I can't wait for you to break that one down. And these aren't just regulatory compliance moves. They're strategic positioning to try to eliminate banking intermediaries entirely. So we're also going to cover a couple other things, like Rex Osprey launching the first US ETF combining spot Solana exposure with on-chain staking rewards. The S&P Dow Jones indices, they also announced that they're collaborating with Centrifuge for S&P 500 index tokenization. I mean, there's a lot of things that are going on, and this is really representing the bridges between traditional finance and Web3 infrastructure that are going on. And Rob, I'm just curious, with all of the stuff that's going on, and we didn't even hit on everything that happened in July, what are you looking forward to the most to talk about in this episode?
Well, it's definitely the Genius Act is the signature event in the month of July, the first major U.S. law affecting cryptocurrency. But there is a lot more than that. And, for example, one of the smaller, less noticed events is the guidance from the federal banking regulators on crypto asset safekeeping, which opens the door for banks to do more and get more involved in this industry. So that's just one example. And I look forward to getting into the details.
Yeah, well, that's perfect, man. So here's why this matters for those listening. I mean, July of 2025 really represents, and I know I've been saying this every month, but it feels like every month I have to repeat this because we make another milestone, but it really represents the end of the experimental phase and the beginning of the implementation for a true Web3 America. And the best part about that is the regulatory uncertainty that really kept people from getting involved, whether it be institutional capital or others, keeping them on the sidelines. All of that has pretty much vanished. Now, it's not completely gone, but it's pretty much made its way out with the Genius Act, as you mentioned. Infrastructure barriers that made this enterprise adoption risky, they're being solved with banking charters. The international competitive pressure is really pushing things forward. And it's starting to align, as we mentioned before, with the Asian regulatory frameworks. Now, one of the things that I think has been really interesting is when in 1 month, the month of July, you see $5.3 billion flow into digital asset projects. I mean, that's the strongest month since January 2022. And yeah, we had the Genius Act become law and stable issuers are chasing those bank charters, but that isn't the only thing that's driving that forward. I mean, like I mentioned, the regulatory clarity, there's just so much stuff that's going on. So everyone, I want you to stick around. This may be one of the most important conversations around Web3 you'll hear this month. And we'll be starting with the market trends that prove that institutional America has returned to Web3 with serious money and serious intent. Let's start with these market trends that prove institutional confidence isn't just back, it's back with serious conviction. First, as I mentioned, we have record VC surge of the year. As of July 2025, crypto's venture capital reached $10.03 billion just in Q2. And with July hitting $5.14 billion. Rob, that's the strongest month, as I mentioned, since January 22. When I look at the crypto fundraising reports, this represents the highest quarterly funding we've seen since 2022. But the funding is spread across blockchain infrastructure, DeFi protocols, stablecoins, blockchain service sectors. It doesn't feel speculative anymore. It really seems like it's moving with a purpose. Now, and I know the second thing that we'll be covering today, like the second thing in this market area, I know we mentioned ETFs, like I think every episode. It's kind of hard not to do it because new things keep happening. I mean, Rex Osprey launched their first US ETF combining spot salon exposure with on-chain staking rewards, and their technical details, really matter because this ETF holds majority assets directly staked in Sol, and with the remainder SOL staking ETPs and liquid staking tokens. And not only that, but it's listed on major US option exchanges and providing institutional access to Solana staking yields. And this is an infrastructure that really didn't exist even 6 months ago. I know you'd mentioned that the FATF had, I believe what I was hearing is it really opened the door for this.
That's right. On prior episodes, we've discussed all the various guidance that has come out from the SEC beginning in January, and really every month of this year, we've had significant guidance from the SEC. One of those statements was the statement on certain protocol staking activities. And in that statement, the SEC explained that certain activities around proof of stake networks and some of the infrastructure providers around operating proof of stake nodes on those networks would not be considered to be offers and sales of securities under the Securities Act and the Securities Exchange Act. And that gave a lot of confidence to market actors who were engaged in staking that they weren't going to run afoul of the securities laws. I believe we discussed this on a prior episode, how that opened the door for ETFs that were based on proof of stake networks, like the Ethereum network, like the Solana network, to launch an ETF product where the ETF is not only just holding the crypto asset, but actually staking it and earning additional rewards. And here with this development, we now see it happening, and it's happening for the first time. And I do believe that, this is one of those instances where we have two seemingly unrelated events, ETF approvals and the SEC staking guidance, that are actually quite related and have now resulted in real movement in the marketplace. And I do think we'll see more of this in the months to come.
Well, and not only did that happen, real world, I always have a hard time with that. Real world tokenization of assets. It just keeps hitting milestone after milestone. And as I mentioned in the intro, the S&P Dow Jones indices announced the collaboration with Centrifuge for the S&P 500 index, and they're licensing this to Centrifuge as a Web3 asset management. And what I found really interesting about this is that they plan on tokenizing the entire S&P 500 index sphere. And really they're waiting for regulatory approval. And I find this really intriguing. This is one of the times that we're starting to see the line blur between traditional finance and bringing things on chain. What is this something that we might be missing when we look at this real world asset tokenization trend?
Two things come to mind for me. The first is, and this is related to the the update we just talked about with the ETF that is operating a staking node and earning staking rewards, similar to the ETFs that are now engaged in staking, with a company like Centrifuge that is helping to facilitate the creation of tokenized real world assets. What we see in both instances is that there is now a growing market for blockchain infrastructure providers to create these new assets in the marketplace. And that could be a provider of staking infrastructure for an ETF. It could be a company like Centrifuge that is helping to launch tokenized real world assets or other tokenized products. But behind the scenes, you forget about the actual product for a minute. Behind the scenes, I think we are seeing a growing demand for battle-tested blockchain infrastructure coders and companies that can bring these new assets to market. Now, some of these assets will succeed, some of them will fail, but I think we are seeing a growing demand for those infrastructure providers, and that's tied also to the VC investment numbers that you quoted earlier. So that's kind of the first thing that I think is operating behind the scenes. It is that growth in the need for the tech development to launch these things. Secondly, with the concept of a tokenized S&P, to me, it demonstrates that the crypto trading environment is establishing itself as a stronger piece of the overall global trading environment in terms of equities, traditional equities, commodities, securities. Tokenized assets are becoming a part of that and becoming just as formidable, on the way to becoming just as formidable as some of these more traditional actors in the global asset trading space. And the reason I say that is the whole need for, or the whole concept of tokenized S&P is designed specifically for traders who don't want to deal with sort of the traditional systems for trading these assets. They want to deal with it and trade these assets in a blockchain on-chain environment. And they want to trade those assets alongside other crypto assets like Bitcoin, like Ethereum, and like all of the other layer 2 products available on Ethereum, Solana, and other L2 networks. And they want to trade the S&P alongside those as if it's all part of the same portfolio. So that's another interesting trend I see in terms of what the driver might be for a product like this.
I think one of the things that as I'm sitting back looking at all this, I'm seeing the pressure to be able to make these trades 24 hours a day, 7 days a week, move it quickly, move it easily, just like what like you mentioned, like they're used to doing that with digital assets, and now being able to bring that on chain, bring the traditional financial assets on chain as well. Now you get that benefit of that instant, and I shouldn't call it instant, the real time ish, I guess you would call it. But now you're not locked into, is it a federal holiday? Is it 3:00 in the morning? The time no longer matters.
And in an on-chain environment, and that's a great point, Ted, it's 24/7. And it's also, I want to note, it's borderless. So it's
True.
Irrespective of national boundaries as well. And those are two things that, frankly, the traditional markets don't have.
Well, with all of that activity that we just talked about, obviously things are heating up quite a bit, because one of the things that, I think it catches everybody's attention anytime the Bitcoin hits a new high, and especially when we reached $123,000 a coin, that in itself surged the market cap by 13.3%. Now, I know that doesn't sound like a lot, but think about it. We're not talking like going from $1 to like $1.13. We're in the hundreds of thousands of dollars at this point, and seeing double-digit increases is pretty much unheard of. And then you look at the other side of the house, and as that surged, Ethereum, it went crazy too. Over 50% price increase, 127.7 surge in corporate holdings to over $2.7 million. 2.7 million ETH. I said, see, I'm already falling back into the fiat side of the house when I'm thinking about this, right? But the really interesting thing I found was with that growth of ETH, Bitcoin's market dominance fell down to about 61%. And then Ethereum climbed up to nearly 12%. So I find it interesting that we're starting to see some large scale diversification. We've had a lot of Bitcoin maxis, and then you had people who are like dabbling in all these different areas. But now it's starting to show that, I mean, ETH had a surge, Bitcoin's had a surge, XRP's had a surge. I mean, I could probably go through the list of the top 10 and just see them all grow. You could almost have predicted it when you start looking at some of the reports that went out. I mean, Binance did their report for June and they released that in July, and it was showing it heading in the right direction. I mean, the Circle going public, that headed in the right direction. USDT, even though it's not a US based item, it's gone up by 24. I mean, it's like all these things are going on. And I'm thinking it's kind of funny that earlier we talked about it being an altcoin summer. It looks like it's an altcoin summer, really what has happened here. Because one of the things that I wanted to mention is that these altcoins have 39.2% market share. At least in July they did. And again, we're starting to hit these highs that we had back in 2022, because the other thing we talked about in a previous episode is the fact that NFT sales were at the all-time low and they hadn't done anything and they were crashing. Well, July proved us wrong because the volume over there jumped almost 50%, and it included a single purchase of over 45 different CryptoPunks NFTs. I mean, there's just so much stuff going on here. I'm just excited to see that it's heading in the right direction. And I think you and I talked about this, is that the Genius Act, the White House report, all these different things really seem to be fueling the growth in these areas. And there's some other economic factors that are in play as well. But what are something that maybe would be thinking about when we see all these numbers headed in up and to the left, or up and to the right, I should say?
Well, I always like to say I'm an expert on the legal and regulatory issues, not the price. So I'll start there. And I do tend to look at some of this stuff from a legal and regulatory perspective. And I agree to your point, the enactment of the Genius Act, the publication of the President's Working Group paper absolutely very likely have had an effect on some of these numbers. In particular, with the Genius Act, stablecoins are now mainstream and are now part of the mainstream financial system. Many stablecoins exist on the Ethereum network, and that may have had an impact on some of the numbers that you quote with respect to Ethereum. But another piece that I think goes unnoticed sometimes is stablecoins also underpin and are the backbone of the larger DeFi system. And the decentralized finance marketplace relies on stablecoins for liquidity. So with the Genius Act creating a framework for stablecoins in the US, it's not just about the US dollar and the US financial system, because those regulated stablecoins also underpin the entire decentralized finance ecosystem. And so I do think that there are downstream effects on even obscure DeFi protocols that originate with the confidence to the market that the Genius Act provided. And then similarly, the President's Working Group paper being published really gives the executive branch stamp of approval on a lot of the actions that the SEC has already taken this year, beginning in January, and even is pushing the regulatory agencies like the SEC, like the CFTC, to even take it a step further and further promote the digital assets industry in the US. And again, that would likely have positive effects on some of the numbers that you were describing. both in sectors related to more of the traditional financial space, things like Bitcoin ETFs, publicly traded companies that have established Bitcoin treasuries, things like that. But also, again, in the larger decentralized finance space, because those markets are actually tied to the more traditional use cases for crypto assets, and stablecoins are kind of the bridge there.
So what did you find the most surprising out of all of the market changes that happened?
Well, I think we'll get into this a little later on in the episode, but the fact that two of the major US dollar stablecoin issuers have announced that they are seeking bank charters. It was significant, certainly surprising at first, but when you think about it, maybe not all that surprising. One of the reasons why is the Genius Act creates a framework where there are a couple different ways to become what's called a permitted payment stablecoin issuer in the US under the Act. One way is to be a subsidiary of a regulated bank. And then another way is to be a standalone stablecoin issuer. In both instances, the corporate entity will have limited activities. But if you are a subsidiary of a bank, that potentially gives you a quicker path toward going live with a stablecoin issuance being tied to a bank. And that could be a reason for two of these major stablecoin issuers to begin to seek bank charters so that they don't have to be regulated under the alternative approach, whether it's a standalone entity with limited activities, but instead would be regulated as a subsidiary of their own bank. Similarly, the Genius Act, of course, requires U.S. banks to custody the reserves backing the stablecoin. And you can't help but wonder if these stablecoin issuers are interested in launching a bank so that they can custody the reserves for their own stablecoins rather than rely on a third-party bank to do that.
I will agree. I think that was the biggest surprise for me. Not that it happened. Let me first say, not that it happened, but it happened so soon. I expected them to wait for some more regulatory things to clean up and a couple of the other different bills to be passed before diving headstrong into it. But the guidance that has been provided by the White House and by the House and by Senate obviously gave them enough confidence to move forward with that. And so, yeah, you're right. We will dive into that a little bit deeper here a little bit later. But, one of the things, as I was looking at the market research that were out in July, talking about the market, seeing that all these different things. I mean, obviously, stable coins are making a run for it. But one of the things that really stood out to me is the altcoin data. And we talked about altcoin summer earlier, but they increased volumes like a lot. Like we're looking at nearly 40%. I'm going to skip over that. Can I mention Coinbase?
Yes.
So one of the most popular, I'll call them crypto platforms, and at least in the, in the US, they are just blowing it out of the water. I mean, so Coinbase, when you look at their numbers, they hit a 6,200%. I said to make sure I was reading that right. 6,200% increase in average trading volume year over year so far through 2025 when you compare it to 2024. And then they expanded their perpetual futures from 15 to 106 contracts. And they're hitting all-time highs in open interest and 24-hour volumes. Now, their strategy was really aggressive. They were planning to add 50 to 80 new cryptocurrency listings and in the first half of 2025, and then focusing on day one listings. Despite the Q1 challenges that we had, they actually maintained a 24% year over year revenue growth. And one of the things that we don't talk about a lot because a lot of people are looking at it from the consumer perspective, because we all are. Their institutional desk now represents over 27% of overall fee income, which actually surprised me quite a bit. And they processed over $2.8 billion in crypto payments for the first half of this year, generating over $41 million in fees. The U.S. spot trading market share rebounded to 55%, up from 49%. So they're heading all the right directions there. I also thought it was interesting that the tokenized stocks that we talked about earlier hit about $370 million in value, which represents about a 220% surge in interest, showing the characteristics that were very similar to early DeFi booms. Rob, I keep coming back to this, and maybe I'm just harping on a little too much. I really think that the regulatory clarity is really making people feel super comfortable. But from a legal and regulatory standpoint, what does this competitive positioning tell you about where the market is headed? Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how. What does this competitive positioning tell you about where the market is headed?
First, I would say we're seeing the effects now 6 months into a new SEC and an SEC that has consistently put out guidance on a month-to-month basis that has been providing all kinds of clarity to the marketplace. We're seeing the effects of that now 6 months in. Second, in the month of July, as we've discussed, passage of the Genius Act plus publication of the president's working group paper on digital assets provides additional stamps of approval and additional tailwinds to all of that, specifically and especially with the stablecoin market and the Genius Act, the very first law on the books in the US governing cryptocurrencies and digital assets. So that's the first piece of it. Second, as you're commenting on some of this market expansion, I can't help but think of a quote that I've always used that I'm going to probably start to adjust. And that is that there's really only, I used to always say there's really only about 1% of the US population that actually cares about this stuff or is actually following it. And what that tells us is that this is a small market. And always traditionally has been a small market, and a large portion of the US population and even global population isn't paying much attention. Well, what does that mean? That means that there's a lot of room for growth. And I think we are starting to see some of that growth where I don't know if it's 1.5% are paying attention now, or if it's 2% or 5%, but I tend to think that it's a larger percentage of the global marketplace paying attention now to the digital asset industry than, for example, a year ago, 2 years ago. And if we're growing from a 1% interest to 2% or 5%, there's still a lot of potential market entrants out there who are not involved in this marketplace. And that means opportunity for companies in the digital asset space to reach those users, both from an institutional perspective and a retail perspective.
I want to dive into the USDG, and because this was a little interesting. I mean, obviously, they launched it at the beginning of July. It is the first major stablecoin under the MiCA regulation, and like I mentioned before, it's opening up access to over 450 million consumers across 30 countries in the EU. And what strikes me most about this is the regulatory structure is really interesting. I mean, it operates under triple oversight from EU's markets, the Finnish Financial Supervisory Authority, and the Monetary Authority of Singapore. This isn't like a single place. It's hitting like 3 different jurisdictions. And this is all being brought to market through Paxos. And this isn't just Paxos that we know here in the US. This is through Paxos Issuance European division, which is Finland based and created specifically for the EU compliance. From your perspective, potential implications for having these multi-regional compliance frameworks?
That's a great question. And it does exemplify that this is still, despite the passage of the Genius Act and despite the launch of USDG in Europe and the continued dominance of USDT, the stablecoin market is still growing and still has a long way to go and is still fractured. Let me try to maybe break it down a little bit. We really kind of have, in my view, 3 pieces of the stablecoin market, 3 main pieces that are kind of the high growth areas. We've got the US piece, which essentially consists of the major US based stablecoins, including USDC, PYUSD, USDP, GUSD, RLUSD, the newly launched, which will be regulated under the Genius Act and have been launched in a way such that they are preparing to be regulated under that act. And those will be the major stable coins that merchants, businesses, individuals based in the US will transact with. Across the Atlantic, in Europe, under the MiCA legislation, and with USDG being the first major US dollar-backed stablecoin now issued in Europe, European retailers, European merchants, European businesses, European institutions will be gravitating toward USDG, as well as, by the way, another stablecoin launched by one of France's largest banks that is now MiCA compliant as well. That's called USD Coinvertible. That's a long name. But I think those 2 are the 2 major competitors that we're seeing right now in the European market. As you mentioned, USDG launched by an affiliate of a US company. And so that's part of an extension of the larger competition in the US. And so it may very well be that we see additional market entry points by affiliates of US based stablecoin issuers. Certainly USDC would be one of those. I'm sure PYUSD would be another, and RLUSD would probably be another that we'll see attempts to enter the European market or make more inroads into the European market in the months ahead. And then outside of all that, now think about outside of Europe, the rest of the world. That's where USDT is actually the primary stablecoin that is used to store and transfer value in the crypto markets from a stablecoin perspective. And so those are sort of we've got kind of this tripolar stablecoin environment from a global perspective. It'll be interesting to see how those 3 different submarkets begin to intermesh with each other, because that's naturally going to happen. And for example, will we see a US regulated version of USDT? Good chance we will. How long will that take? It's hard to say. Similarly, will we see some of the regulated stablecoins in the US and Europe look to take some of the market share that USDT has outside of those jurisdictions? Maybe, maybe not. It may be that the US and European markets are enough to satisfy demand, at least for the short term. And it may be that conquering those markets is more of a concern than the rest of the global market. But at the same time, while that's happening, retail consumers outside of the US, outside of the Europe, and we've already seen this with some of the data, are showing strong demand for US dollar regulated stablecoins because it's still viewed as a safer store of value, even safer than USDT in some instances. So that's a little bit of color on, I think, what I'm seeing at the larger issues at play with what you've described.
Well, one of the things I find super interesting, and you laid it out really well. I mean, how many different stable coins are there? There's a lot. And out of all of those stable coins, dollar-backed stable coins represent over 97% of the worldwide stablecoin market. And it's estimated that the value of that is about $215 billion. And we were talking about Europe, but in Europe, the ones that are used there, over 99% of those stable coins are tied to the US currency. And I feel that the European Bank views this as an accelerated digital dollarization risk. I know we talked about that in past episodes, but Europe's making some aggressive moves into that. And they want to make sure that the existing payment infrastructure dependency doesn't overtake what's going on. I mean, 61% of Euro area card payments in 2022 were processed by international card schemes. And 13 European countries entirely relied on them. And so I'll looking at what the Europe Central Bank, I want to call it the Central Bank of Europe every time for some reason, but the Europe Central Bank executive board member, and I'm going to destroy his last name, Piero Cipollone. I know I'm destroying it, but he basically has said his concerns are that the stablecoins pegged to the US dollar poses risks to Europe's strategic autonomy and monetary sovereignty, and that the ECB's position is that the alternative foreign payment solutions could lead to excessive dollarization in Europe and undermine their monetary sovereignty. So it's really interesting to see how they're looking at it, and the fact that it's a USDG that was launched under MiCA. So I find that very interesting myself. Like when you look at the dollarization piece of it and I know you kind of started to mention the competitive positioning of what's going outside the US. How are you seeing that impact what's going on inside the US with American stablecoin issuers and how they're looking at their overarching strategy?
Well, with the Genius Act now law, any stablecoin issuer, would-be stablecoin issuer, as well as any bank in the US, as well as any fintech company in the US, has to ask themselves, how is my business going to play in the stablecoin market? If the answer is not at all, then you're going to be one of the losers under the act. You have to have a strategy, but there are different types of strategies. And I think that a lot of what I discuss in the marketplace with clients and contacts is how to craft a strategy that is fit for purpose for your specific business model. Because there are a lot of different ways to play in this new regulatory environment. Everything from custodying stablecoin reserves as a bank, banking crypto companies as a bank, to issuing a stablecoin, to, as a merchant, accepting stablecoin payments in e-commerce transactions. So those are just some examples. But from a US perspective, now with the Genius Act, the primary stablecoins that will be considered as companies plot out those strategies will be those stablecoins that are well positioned to comply with the Genius Act when it takes effect. And will that have an effect on the touch points that those businesses have with stablecoins outside the US? I think absolutely it will. But at the same time, you don't want to box out the entire foreign markets. And so there will be appetite, I believe, for coming up with solutions for how to allow your business operations to interact appropriately with the foreign stablecoin markets. But I do think in the short term, there sort of will be these two kind of walled gardens, so to speak, US and non-US, with sort of the US side being the stablecoins that are designed to comply with Genius, and then everything else. And so you have to have two different strategies, one for Genius regulated stablecoins and then one for stablecoins in the foreign marketplace. And by the way, the Genius Act does allow for foreign stablecoin issuers to operate in the United States, in compliance with the act itself and with approval from the Treasury Department, as well as other requirements.
Do you think that by having foreign stablecoin issuers enter the U.S., do you think that'll reduce the number of stable coins and consolidate some of it? Do you think it'll be allowed to expand further? Like what impacts are you hearing about when it comes to the sheer volume of stables that are being looked at and or being used?
Well, the Genius Act creates a pathway both for US stablecoin issuers and foreign-based issuers. My opinion is that it will be initially easier and a clearer path for US-based issuers. So that would probably, that will favor US-based stablecoin issuers in the short term. But I don't think the act intends to block foreign-based stablecoin issuers from operating. I think there will just be some enhanced scrutiny over those issuers. And there are some pretty hefty fines for example, foreign stablecoin issuers that are servicing customers in the US without approval under the act. So I do think there will be some heavier scrutiny of foreign-based issuers in the short term, but long term, the intention seems to be to allow the foreign issuers to compete, on all things considered level playing field with US-based issuers. But again, more straightforward path for US-based issuers, certainly in the short term.
Well, I mean, we've been hinting at it all episodes, so we might as well dive into it. Right? So at the beginning of July, on the 18th, Genius Act came into effect and then, was passed. And then on the 30th, the White House published their report, the Strengthening American Leadership and Digital Financial Technology Report. Well, that is a mouthful. Really to really put a blueprint together for what's going on. And I think it's interesting that the guiding and establishing the National Innovation for U.S. Stablecoin, which is the Genius Act. I want to give it the full name so people know what's going on with that. Really has transformed the stablecoin recommendations that go around that. And one of the things that I took away from looking at both of those documents is, one, they anchor dollar-backed stablecoins at the center of the U.S. digital asset strategy. Two, they clearly separate payment stablecoins from securities and commodities regulation and removing the SEC and CFTC overlap, which is I'm super stoked to see that. And then lastly, but not least, is really the direction of shifting compliance from enforcement driven to risk-based, fit for purpose financial regulation. So that's what I took away from both. And those are like the top three things that I took away from both of those pieces. What would you say, Rob, are the top three things that you took away from the two documents?
Well, from the Genius Act, my number one takeaway is that I believe the real winners are the U.S. retail users of stablecoins and then the merchants and businesses that now have new opportunities to integrate stablecoins into their business models. And I said it earlier, I'll say it again, but with the Genius Act, stablecoins are now part of the mainstream financial system. And so in the same way that a retail user or a business will ask when they need to pay somebody or receive payment from somebody, will ask, what's the easiest, most cost-effective way to facilitate this payment? And there are different options out there in the marketplace. Now stablecoins will become one of those options. They will not always be the preferred option in every scenario, but in some scenarios they will be. And the reason for this, and the reason why I believe retail users and merchants and businesses are one of the winners here, is that the act really fundamentally brings a lot of very basic consumer protection measures into the law that should give confidence to the market that stablecoins are a safe and effective means of facilitating payment. So what are some of those things? $1-to-1 dollar reserves, US dollar reserves of US dollar equivalents backing stablecoins held by US banks, monthly reports by US public accounting firms that attest that there are reserves, in fact, backing every stablecoin in issuance. For larger stablecoin issuers, those that issue at $50 billion or more will have to have audited financial statements, just like any public company here in the US. And as a side note there, but by the way, the auditing firms are winning here because they're going to have to perform those reports. And then,
it's funny you mentioned that, because as I look at like what I listed out is as my winners. I guess I just made the assumption that the consumer wins, but I had on here like reg tech, like all these reg tech companies, analytics, digital ID providers, some way to provide a predictable reserve attestations, online on-chain risk scoring, advanced KYC solutions, like all these different things, plus all the auditors that are going to get into play, especially with the OCC trust banks and the foreign issuers having to come in and get on board as they come in. I just see firms that fall into that area just being completely overwhelmed. But not only that, but now we have a path for traditional commercial and community banks to get involved in this as well, which then again increases auditors and technology providers and all these different things. So I think it's funny that you brought up the auditors.
And coming from a background of both law and accounting, those are some of the things that come to mind for me. But I will say that these are some of the things that give people confidence in the U.S. financial system. And so we're using a lot of that same methods of building confidence in the U.S. markets. We're bringing all of those to bear in the Genius Act and using some of those same concepts to underpin confidence in the new stablecoin market. The last one I just want to mention, which I think is a really smart measure, is that in the event that a payment stablecoin issuer goes bankrupt, first priority goes to the retail holder of the stablecoin in that insolvency proceeding. Second priority goes to the custodian, the bank that's custodying reserves. Third priority goes to the actual stablecoin issuer. And so, we've seen major bankruptcies in the crypto and digital asset space over the last 5 years. And that's another measure that I think is going to give the market confidence that if in the event that something like that happens, the retail holders will be protected.
Well, and the people that I should say the groups that I feel are probably going to come and be on the losing end of the Genius Act and the White House paper are ones that stablecoins that are unlicensed first. Secondly, are not pegged to the dollar, because now all of these other, we'll call them stable coins, no longer meet that criteria. So that's going to push them into other areas, which then leads into some offshore exchanges that are exploiting some of the regulatory arbitrage. And they're going to get just completely cut off from the US markets, which is going to be interesting to see. This is a little bit of tongue in cheek. The SEC's crypto enforcement division, unfortunately, is a loser in all of this fun stuff. But the other place that I see it is we've taken a really strong stance towards not having a CBDC. So the advocates around that have really, really lost a lot of ground in that piece of it. One area that I think is a potential loser if they can't keep up are going to be these legacy cross-border payment and remittance providers. If they can't offer stables as part of their platform, if they can't integrate, as we were talking about earlier, with on-chain assets, with on-chain functionality, they're going to lose out. They can no longer rely on the high cost of SWIFT and correspondent banking systems. They're going to have to readjust. And I think that's one of the places where if they don't readjust, they will be one of the major losers.
I agree. And I kind of put that into the larger category of companies that don't pivot will be losers. And we've listed some of them already, but generally those will be foreign payment stablecoin issuers that don't pivot to comply with the Genius Act, banks and payment companies and remittance providers that don't pivot to figure out where they play into the new stablecoin market and make investments in those areas. Then one more that we haven't mentioned yet. So the Genius Act creates a framework for state stablecoin issuers. So stablecoin issuers that are operating under state-based regulations that comply with the act, that are approved and overseen by the state financial regulator. But in order to do that, a state will have to have a stablecoin regime in compliance with the Genius Act. And so we're likely to see some states that are winners and some states that are losers here. The states that are winners will be the ones that pass legislation consistent with Genius Act and that allow for state-based stablecoin issuers issuing stablecoins under $10 billion in market cap to operate through a state oversight framework. And the losing states will be those that don't take any action and have their businesses and residents using stablecoins issued by companies chartered under other states or at the license under the federal stablecoin framework.
I don't think it'll be any surprise Wyoming being first. But then we have other states like Texas and Florida that will be there as well really quickly, I believe. It'll be really...
And just like any business, each state will make its own decision of where it wants to play in this new environment. And maybe for some states, it doesn't make sense to enter right away. But at a minimum, I would argue that every state should be having these conversations.
I'm going to be really curious to see where New York falls because they've been very headstrong in controlling anything having to do with digital assets, a very strong hold on it. So that'll be one that I'll be interested in watching, see what happens there. California with the population and the GDP of the state of California, like that'll be another one to really, really see what happens there and how they regulate those pieces of it. So now that we've had fun with the White House paper and the Genius Act, and we dove into that, there's so much more that can be covered in those pieces. And folks, if you have any questions, let Rob or myself know. We're more than happy to walk you through any of the questions you may have on that. Just reach out to us on LinkedIn. We'll dive into that with you, no problem. But I want to move on from the regulatory updates and all the way into, and Rob, you hinted towards it at the very beginning of the episodes, the fact that the infrastructure for stablecoins and stablecoin issuers has completely shifted. The fact that they've decided to get into the banking game and they're not waiting on the sidelines, waiting to find out what to do next. They're going after direct federal banking access and a number of other different routes. The first one that came out was Circle when it made the move on the 30th, filing with the OCC for the first National Digital Currency Bank North America. Wow, that is a long name. You would have thought they could have found something a little bit shorter. But as you alluded to, this isn't just a normal application. I mean, they're going for a federally regulated trust institution status. And what really stands out here for me is that this won't be a traditional deposit-taking bank. And the capital requirements, as you mentioned, are lower than what we're used to seeing. And the oversight is very, very tight. And the standards are super clear. And I see this really helping get USDC to be even more secure. Like I mentioned before, this really surprised me that they locked in so tight shortly after the Genius Act came in. And it was almost as if they had a little bit of inside baseball knowledge to jump out into the market. But why don't we talk about Circle first, and then we'll jump into what the other player decided to do.
Well, I think as all of the preparation around the Genius Act was happening, it at some point became clear that Genius was going to get passed. And when Genius gets passed, the basic business model is a stablecoin issuer that then has reserves sitting in a US bank. And so fundamentally, each stablecoin issuer has to ask themselves, who's my banking partner? Or who are my banking partners? And there are other partners that will be required. For example, you mentioned audit firms, but it's really the banking partner is the most important. And I believe that a lot of the market was thinking about this in terms of stablecoin issuer partnering with bank. Well, the development you just mentioned really shatters that paradigm, because now we have stablecoin issuer partnering with itself as its own, partnering with its own affiliate banking institution under its own banking charter. And that is now the new potential model for how this could play out. People have been saying for years now, digital assets are going to eat the lunch of the banking sector. And I think this is a great example of how we see that now starting to come to fruition. On the flip side, banks now might see this and say, hey, maybe it's time for us to make a play here and, for example, use some of the provisions of the Genius Act that allow for a bank subsidiary to issue a stablecoin, and for a bank to now use that same model where the bank and the stablecoin issuer are affiliates of the same company rather than two different independent companies partnering to launch these solutions. So I think from a big picture, I think the market viewed this paradigm in one way, where it was going to be an issuer and a bank partnering together. But now we have a different model for this, which is the issuer and the bank being affiliates of the same company. And I think we will see stablecoins issued under both models, and we will see banks engaging in crypto and digital asset activities under both models, both where it's through a bank affiliate or where it's with an independent third party business partner. And it will be really interesting to see which of those models proves to be most effective from a business perspective.
Yeah. And I think it's interesting that, when you look at Ripple, they decided that they didn't want to take a chance. So they've decided to go down in a dual track process of one, pursuing a national trust bank charter and direct access to the Federal Reserve payment infrastructure. And this allows them to not rely on outside banks and to have the platform and send the reserve straight through the Fed. I mean, this just kind of is a next level approach. It didn't surprise me that they took this approach. It surprised me that they took this approach in parallel with each other.
And I would say it also doesn't surprise me now in retrospect, but it does surprise me how soon this happened, to your point, Ted. And I think it just shows that the digital asset market is taking an aggressive stance right now, as they should, based on the current regulatory environment.
Well, and the announcement came out maybe hours, maybe a day after the SEC was officially completely squashed. The lawsuit with the SEC was officially just terminated. So I thought that was also another piece that came into play. Rob, you touched on it a little bit, and I'd love for you to kind of just give a little bit of a clear outline to how Circle's approach is different than the way that Ripple is approaching it.
Well, in terms of the technical architecture, Circle USDC is now live on multiple blockchain networks. Started on Ethereum. It's now live and operational on probably at this point over a dozen different blockchain networks. Our LUSD resides on Ripple's network. And so that's a key distinction, I think underscores the point you made, that Ripple's approach is to really try to control, seems to be to really try to own and control the infrastructure at every angle of these offerings, taking it so far as to attempt to gain access to a master account at the Federal Reserve. That's a huge distinction between the approach that Circle is taking, at least for now. And it will be really interesting to see what that journey looks like for Ripple. As you know, a couple of years ago, I believe it was around 2022, 2023 period, we had another major bank that sought access to an account at the Federal Reserve master account and failed in that endeavor and went through a lot of legal processes to try to appeal that decision and ultimately failed. And so this will be the second time that we see a digital asset native company attempting to gain access to a master account at the Federal Reserve. So it will be really interesting to see how that plays out with the new environment that we're in. And coming back to Circle, the competitor, it'll be interesting to see if they take a wait and see approach to that, or if they begin to take steps to also seek to obtain a master account at the Federal Reserve and view that as a competitive advantage that they think they need to have. Outside of those two companies, I think there's going to be a wide variety of how other competitors react to this. I don't think that every stablecoin issuer needs an affiliate banking institution. I don't think that every digital asset bank needs account level access with the Federal Reserve master account. And so I do think it still remains to be seen as what the right combination of all these different licenses and approvals is for any one particular business model.
Yeah, I think we're going to see a flood of applications and a flood of requests for these types of things. But really the big takeaway here is that we could see the elimination of, like you mentioned, the classic banking intermediaries for digital asset firms, and getting into the federal charter compliance really puts, like you mentioned, the focus on the customer protection, stronger oversight, and really starts to offer some new competitive edges for institutions playing in these markets. So I think we're going to see more and more financial institutions really get into it. And when you look at the broader framework of this, it really changes the line up with the insights from the Digital Assets Report, as well as from the Genius Act, to bring that forward. And all of these things are getting folded in together. And like we mentioned, this is a lot more proactive than expected, but it's really going to flush a lot of these things out as we go through it. And Rob, before we wrap up, I want to hit on some of the big points for everybody that is listening. I mean, first off, the White House dropped that Strengthening America Leadership in Digital Financial Technology report. Again, it has over 100 actionable policy moves and seems to really set the stage to drive us towards that innovation versus regulation approach. Your favorite, the Genius Act on July 18th, became law. And that one there is really giving us the framework to really drive things forward. We've seen funding in 2025 just get blown out of the water for digital asset space products. Like we were mentioning before, it just continues to go. Then, of course, we've got, as we just finished talking about, these stablecoin issuers filing for bank charters and Fed access, and that's going to keep going. And we can't leave out our friends in the EU that is really trying to establish a presence in the stablecoin space as well. The landscape, from my perspective, as of July 2025, is that we have clear rules. Big checks are getting written. We have a much stronger infrastructure that is coming into play, and the competition is really heating up. And I want to really thank you for joining me today. I think the next few months are going to be just as interesting and getting interesting so much more over time.
Agreed. And I'll close by saying once again, crypto is now mainstream, and it's going to be a lot of fun to see where this all heads.
Well, folks, that's it for today's episode of Web3 with FTC. If this discussion about Web3 caught your attention, that's great, because there's a lot more where this came from. So go ahead, head over to YouTube, Spotify, Apple Podcasts, or wherever you listen, and hit the follow button. And if you haven't already, head over to theblockchainmonitor.com and sign up to see what Rob puts out every single week. If you want to continue to stay plugged into everything we're doing here at FinTech Confidential, go ahead, head over to fintechconfidential.com and sign up. That's where we drop all the deep dives as well as the future episodes. You'll be able to learn a lot more there. And be sure to share this with someone who's serious about where FinTech is going. And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.